We've got Sandip Agarwal on the phone line. He's fund manager and co-founder at Sovilo Investment, and someone who understands the space that is in most pain today in the markets very, very well. I want to pull up the Nifty IT, 4.5, nearly 4.5% down. It's a meltdown. First of all, Sandip, if you can just tell us your view on what is the trigger. We know this AI threat is happening for a while. What has happened today? What do you think is the immediate trigger, if any?
Hi. Good morning and thanks for calling me on the show. So, see, it is very simple that, now what is happening is every day some or other new product, basically services is coming out from the AI stack. And, as and when it comes, it impacts some portion of business of the service providers. And I think this will not stop anytime soon. It will keep on happening. But remember that the stock reactions are not reflecting the reaction which will happen in the earnings. So let me clarify that, I don't have a view that our revenues or profit will go down so sharply as the stock prices are in the sector. But what is going to happen is that, the nature of business which we do is such that, it is spread over 4 to 5 years. So every year you will have 20% of contracts which come for renewal, and in that 20% renewal time, you will have 20% reduction in effort or 25% reduction in effort. So you will every year lose 4-5% revenue growth, and you have to get that growth. So basically, even if you grow at 10% in new business, your net growth will be 4-5. And because of that, the growth for next 3-4 years for the large cap will be muted in the range of mid-single digit at best. And because of that, the multiple which was there was very high. I have been saying for last 14 to 16 months on every interaction that we have to see the PEG ratios and not the PE ratio. And the PEG ratios are very, very poor, very, very, very high for the industry, and it is unsustainable. So I think it is more of a multiple correction which is happening in the sector. It is nothing to do. I don't believe that you will lose 70% of revenue or 40%. All this is very, very difficult to happen. I don't think that is the nature of the business we are in. Our business is labor arbitrage. We train people, reskill people, and deploy them.
One sec, Sandip. Let's just put all of these thoughts in order and in a cohesive fashion. First point, why now? Is there anything specific which you see as a trigger and a larger concern, or is this a continuation of the conversation that has been happening as daily AI tools are released?
No, it is latter, as you rightly said. It is daily some tools will be released. So that will have an impact. People will start calculating what is the impact on the services business.
Okay. So the latest, I believe, is a real estate consultation kind of tool that has come, which is also putting people, making people more jittery. Now, your point that there will not be a massive slide in revenues, but there is going to be a hit in the number of employees and in immediate kind of business metrics for IT companies, IT service companies?
Yes, so basically we will have pain for longer duration. So we are not like the software or ERP company which will take 60% slide in 1 year and then they will start stabilizing there. We will have every year pain. So we are in for a lower growth for a longer period of time versus a sharp decline in 1 year.
Sandip, you want to enumerate some of these points on PEG ratios, and understandably you may not have the exact figures with you, but just to elucidate your point, if you're talking about an infeed which is down 5% right now, you're talking about a TCS that's down a further 4%, and this is on the back, Sandip, of a 5% crash for the index barely 10 days back. So these PEG ratios would have changed dramatically, right, in the recent past?
They have changed, but as I said, in best case scenarios, let's say these companies will grow at 5-6% and still they are at 18-20 multiple 1 year forward. Yeah. So it is not cheap, right? Why will you pay a 3-4 PEG ratios, 3-4 times PEG ratio for something which is going to grow in mid-single digits? So see, we have been very clear on that this will slowly become like utility companies with much better return ratios, much high cash generation and very low capex. So you may give 25-30% premium to what utility companies are getting as a multiple. So if you do that math, I think for a 5-6% growth, I will not give more than 12 times for 1 year forward or 13 times 1 year forward. It is very tough to assign more than that.
Sandip, while we're at it, you talked about PEG ratio, which is price to earnings to growth. Can you describe why you're saying it's important to look at price to earnings to growth with respect to IT companies?
Because see, what is happening is that last, if you see 1.5 years, whoever is who is positive on the sector, they are again and again reiterating that PE ratio has come down to 10-year low, 10-year mean, and all those one SD below mean and all that. So that is not relevant because 10-year back, what was the growth rate, and today what is the growth rate? So you can't see PE ratio when growth is falling so sharply. So I think PEG ratio is more gives a better picture. And from that perspective, I insist that, PEG ratio in an industry which is maturing is more relevant than PE ratio alone. PE ratio, all this will look very cheap, reasonable because ROEs are superb. But I think the right metric is PEG ratio because it reflects what PE you are paying for the growth.
So that's a more comprehensive way to look at it. By the PEG ratios that you mentioned at 12, currently, you have overvaluations in where your IT companies are, isn't it? Just give us that comparison, Sandip. How much more slide before these become attractive buys?
So I will, every company is trading at different multiple. Let me put it this way, between 12 to 13 times 1 year forward earnings, these stocks will have good value because, you have to remember that you have to wait for the pain in numbers and then you have to exit at a profit. So, if you enter at 1 year forward 12, 13 times forward earnings, then it is a very good price to win. I think we are still little off from there, and I am a firm believer that it will come at some point of time. We can't assign such high, earnings multiple to.
So for perspective, you're saying 12 to 13. Where are we right now?
We would be at between 16 to 18 right now, 16 to 20.
So we have some ways to go before these companies can be bought.